so. So I'm going to go ahead and continue sharing my screen here. And I want to walk back through with whatever detail we need to in order to make sure that we're all on the same page with the different valuation structures. So I'm going to spend a little bit of time with the free cash flow structure, the key value driver model, but only a tiny bit of time on the adjusted present value model. And the reason for that is that it's a seldom used model, and it has these problematic inputs of KU and K tax. And the only reason I introduce it to you to begin with is so that you can get a sense that if you have an asset that has multiple cash flows that are assessed separately, you can create a model that embodies all of them. And it's conceivable that there are different discount rates. Let me give you an example of that. So, and this is hypothetical, this isn't real. So let's say that I have a string of auto dealers, not unlike the Miller dealer system. And most of my auto dealers are here in the Intermountain States. And I have some that are in the Deep South in Florida, and I have some that are in Germany and France. And they're representative of different manufacturers, of different markets. The ones I have here in the United States all share the same manufacturers. In fact, you know that the Miller dealerships span the various manufacturers that are available here in the United States for the most part. There might be some that they don't cover, but it seems to me that if you want to buy a car, you can buy it from Miller somewhere somehow, because they represent virtually everybody other than some of the esoterics or some of the big luxuries. But the ones they represent in France and Germany are completely different still. And the virtue of the fact that they represent in different parts of the country and different parts of the world would suggest that there's a reason that there might be different discount rates, there might be different growth rates. So we might want to think about each of those three areas, Intermountain, Deep South, Europe, as three quasi-separate entities, even though they are all the same company under the same umbrella, but we might need to apply separate discount rates for each of those, and we might need to apply separate growth rates for each of those for their explicit periods, and maybe we can see the Intermountain States operations very clearly for the next 5 years, whereas maybe we can only see the EU operations clearly for the next 2 years. So we might have different explicit periods. But in order to value such a complex asset, we might have to think about multiple cash flows and multiple discount rates, one from each of them. So to me, the virtue of the adjusted present value model to us is being able to consider different cash flows at different discount rates, and then knowing that we aggregate them at the end. And so no, that's the only real reason that I introduced that model to you, is to get you used to being able to do that. And when we do that, each one of those might be its own separate and distinct free cash flow, or we might be using the KVD model to do something. We might even use yet a different model. But once we have identified the value based on the cash flow for each one, we can then aggregate those cash flows, and that becomes the value. Does that make sense? I'd like it to make sense. So I'm going to assume, since I don't see a lot of shaking of head and I didn't see anybody scream, I'll assume that makes sense. So there are single stage models and there are multi-stage models. A single stage model would be some production value where we're able to generalize through a Gordon growth model construction the growth rate, and we believe the growth rate is going to remain constant, which is a pretty broad brushstroke. It's a bold assumption to make, but very often it's an assumption that is made. But we also know that using the Gordon growth model and this single stage construction, and when I say single stage, I'm talking about this equation right here as the single stage. What I'm really doing is I'm bringing in all possible future cash flows into perpetuity at a constant growth rate, because this Gordon growth construction embodies an infinite series of cash flows. And it's really the only way we can embody a series of infinite cash flows, because if we try to use the summation to do it. The moment we end up adding the last cash flow, our buddy Kang says, well, wait a minute, you forgot the next one. And then Emilio delights in telling us we forgot the next one and we can't ever get to a number. But using this algebraic simplification, these two equalities here, CF divided by R minus G and the sum of the CFs divided by 1 plus R to the T, come up with the exact same number, assuming these cash flows that we're summing are growing at this constant growth rate. So this is a single stage model, whereas a dual stage model would be here, where we take the summation of some cash flows during an explicit period, we separately calculate a continuation or terminal value, and then we add that discounted terminal or continuation value to our discounted cash flows, and we get a value. Virtually all of the models that we're dealing with follow this regime. If we can generalize the growth of the cash flows as being constant throughout all time, then we don't have to mess with a multi-stage model. We can go directly to a single stage model. But if we believe there's going to be a change, even if it's only one change in the growth rate of cash flows, we are relegated to at least a dual stage model. And maybe it's a 3-stage model or a 4-stage model. Maybe we change the growth rate for cash flows each of 2 years. So we have 3 periods of 2 years each for the next 6 years. And then we go ahead and put ourselves to a continuation where the growth rate for the cash flows becomes constant thereafter. There's infinite variability to this. Or maybe even we're adding a whole nother model to this because there's another set of cash flows that we hadn't been considering. Something not unlike the adjusted present value model, as I explained it, and its correlate just a moment ago. So single stage models, multi-stage models, and I just need you to get used to having to deal with those, because if you're now valuing a project in a company that you're working with or your own company, you may have to think about multiple cash flows, and you may have to think about multiple discount rates, and you may have to think about multiple periods that go a little bit beyond the pale of what we've done in these very simplified single and dual stage models to a triple stage or a quad stage or a multi-model stage consortium. Does that make sense?
I got a question for you, Rick.
Please.
I wanted to ask, we've been doing these, right? Like, we've been doing both these approaches, whether it's the multi-stage or the single stage. But I'm struggling to think of a situation in which the growth rate would be constant forever, unless you were just assuming your company was only ever going to follow inflation exactly. And again, inflation is not a constant number forever either.
Yeah,
so
right.
I'm curious, is there ever a practical reason in the career place where you would want to do the constant growth model?
Yeah, that's a really good question, Casey, because the technical answer is absolutely not. In fact, I'm going to have a different growth rate and a different cash flow forecast for every year, right? Yeah, so absolutely not. But in practice, most business decisions, when thinking about these, are made using a single stage model. And it's, in fact, sometimes it's using 2 single stage models and then comparing them. And one of them is this model right here, where we take the cash flow divided by a discount rate minus a growth rate, and we get a number. And I'm going to introduce you to a concept of valuation using enterprise value multiples before we're done with the evening. And that's the other single stage model that is sometimes used. And I'll tell you that of the executive decisions that are made that are using discounting, that those 2 very simplistic single stage models are more commonly used than all others combined. And your point is, how on earth are we making critical corporate decisions on such broad brushstroke, error-prone modeling?
I assume it's because those people haven't taken this class.
Well, that would be one reason, but that would simply be stroking my ego, Casey, so you're welcome to do it again when you'd like to, okay? The other is, it's just so simple to do it that way. And we already know these are guesses. And so too often, we fall back to it's a guess and it doesn't matter, when in fact, it is a guess. But the better informed our guesses are, the more productive our decisions are going to be. So your point is very well taken and sadly experienced over and over and over again all the time.
So I'm sure you're just leading into this then, like you're going to talk about the APV model. So both the free cash flow model and KVD model can use the constant growth or the multi-stage valuation, right?
In fact, they all can. Every one of the models we're dealing with can either be a single stage model where we don't separate out an explicit period. We assume growth is constant forever, which I think is a pretty foolish assumption, but it's an easy assumption to make. And maybe we can average perpetual growth to some number that isn't going to blow our minds, or maybe it's an assumption that costs way too many people way too much money, which is the case for most assumptions, right? My goal is to empower you with a tool set so that you limit the waste, and which obviously gets you the promotions, the bigger paycheck, the owning of the companies, and it gets you that great big fat exit so you can live on your private island in the Bahamas. Okay, good point. Well, as we continue on then, so I walked you through, I walked you through an example using the Mira-Dravana case where we did a multi-stage model, which was the free cash flow model. So we have the various free cash flows that we have forecast, and you guys have just gone through, and these are the free cash flows you forecast without adjustments. We then took and discounted them. We summed those discounted free cash flows, and it gave us the present value of the discounted cash flows. We then created a continuing value, and the continuing value for the free cash flow model is free cash flow divided by WACC minus G. Now, this is the free cash flow model, not the KVD model. And we know that we have three different interpretive free cash flows or interpretive equations, right? We have no plat plus depreciation minus change in net working capital minus net capital spending. And that's the common garden variety, very best one to use unless you're told not to. A correlate to that is no plat minus net investment, which should give you the same outcomes. But as a few of you have seen, having used that and having made some problematic assumptions in some of your forecasting, doesn't always give you the same outcomes. And so I warn you against using that. But if you've got all of your inputs are right, then that form of free cash flow and the form that is elongated will give you the exact same number. It's just easy to screw it up. And so I never use it. And then there's the KVD form. And the only place we routinely use the KVD form of free cash flow, and again, that is free cash flow is equal to no plat times 1 minus G divided by ROIC, which is just another form of free cash flow. The only place we use that is in the continuing value of the KVD or key value driver model. Only in the continuing value and only in that supernumerator, which you'll see me replace that in a moment. Well, as I go ahead and put together my continuing value here using the free cash flow in time one, which is 32.685, I divide it by WACC minus G, and which I believe was, the WACC was, 16.59, and the G was 2.5%, I think. That leads me to this 254,311 number. I take the present value of that by dividing it by 1 plus WACC to whatever my exponent is. In this case, it's 5. And it gives me the present value of that, and then I add these two present values together to get my value. That is a basic garden variety free cash flow model, and it is as reliable a production or income approach model as you will find. In fact, I never do a valuation for a real company without doing this. I never do. Whether the owners want me to, whether accountants, attorneys, whatever it might happen to be, I never do. I will, and so always I use this. I might have to tweak what free cash flow means because some companies that don't have extensive asset plans, that we can't forecast the balance sheet, let's say, I might have to morph or adjust what free cash flow means to that company versus the way we look at it in these very nice, clean, neatly tied up with a bow academic environments. And we'll talk about that a little bit next week as to how you might have to morph some of these things.
Rick, can I ask a question? I'm a little bit on what Casey had to say. As I'm working through the final project here, the situation I'm looking at is where I can almost control the growth rate because the demand is so high. You know what I'm saying? So I can actually say this business is going to grow 10%, and that's all we can do right now because of its unmet need. Is there such a thing?
Okay.
Okay. So then I'm struggling with how the three different rates would compare. So the weighted average
You
cost
said the
of
three
capital.
different rates are these three different free cash flows?
Well, the weighted average cost of capital, the growth rate, and then the expected rate of return.
Okay. So I will tell you, Jason, that those are three separate and distinct numbers. Two of them should have a relationship. Which two are those?
The weighted average cost of capital and the growth rate?
No, the weighted average cost of capital and the return on invested capital, or the required return.
Okay.
The growth rate and the WAC and the discount rate, of which WAC is only one form of a discount rate, those two do not have an express relationship. You are fooled into thinking they do because so often we see this WAC minus G thing, right? The reality is ROIC and WAC are two sides of the same coin. Return and cost, two sides of the same coin. And to the extent that there's any difference in them, the difference is because of either transaction costs or because whoever the investor is wants to get a little bit of economic profit. But otherwise, we can rationally suggest they should be the same. Now, let's come back to what you just referenced. You have a scenario in which growth is something that you can simply plug in because demand is virtually limitless at this point, right? And so what I think you're saying is your growth is only going to be limited by the amount of capital that you can attract to allow you to penetrate and take advantage of that, all that pent up or unmet demand, right?
Yes.
Yeah. And as good, prudent capitalist investors, we would love this story. High demand, high growth, reasonable costs of capital. In fact, I'd love growth being greater than my cost of capital, which means my growth is probably greater than my return on capital. As an investor, if I think I've got credible growth there, that is nirvana to me. I mean, I'd rather have that than baklava, or I mean, it's the richest thing I can find if I can raise the capital to invest in it. And so if you have that scenario, your limitation only becomes the amount of capital you can raise. And if your growth is greater than your WAC, you're going to see a negative outcome. You might have seen a negative free cash flow, but you'll at least see a negative outcome. And that simply is an indication in that case that you can't sustain that growth without more capital. You've got to go out and find more capital to sustain the growth. That's not a bad scenario to be in, unless you don't like raising money. If you're constrained by your own capital, then your growth is constrained. If the world is your oyster, and if the markets globally, when capital is actually flowing, as opposed to right now, if the markets are across the globe are open to you, there's virtually unlimited capital access. Does that answer your question or help at all?
It does. And then I don't want to get too all about me, but the one caveat is it's based on reimbursement rates it's in the field of medicine. So reimbursement rates for Medicare is the limiting factor there.
Yeah, you've got an exogenous factor there as well, and that can be a changeable element, right? Because a couple of years from now, it may be different than they were yesterday.
Exactly.
Yeah. As you go further into that project, I'm happy to look at some of those things with you, but just know that what you're dealing with there isn't, you don't have the right vision of the related elements. WAC and WAC, required return, are simply discount rates. And any discount rate should have a relationship to any other discount rate. There should be some connective tissue. Growth may be totally unrelated, but might be constrained because of the ROIC and the WAC relationship. That would be internally constrained.
Okay.
Good questions. No, I like that. Thank you. So let's just look at the free cash flow model, or excuse me, the KVD model. Remember that here we have 172.788, and now we're going to the KVD model, and the only thing I've changed here is this supernumerator. This no longer says free cash flow, but in fact we know that this is the key value driver form of the free cash flow equation. So the KVD model and the free cash flow model are the exact same models with a slightly different interpretation of what the supernumerator is in my continuation term. Everything else is the same. These free cash flows are the same. These discounted values of the free cash flows, the sum of the free cash flows, and this then is the same as well, but this continuing value differs, and so the overall value. Remember we had 172.78, I believe it was, 172.79, and now we're at 172.29. So tiny differences, same models, or tiny differences in outcome because our models are only slightly different as well.
So I have a question about this.
Yeah.
Since we are coming off the back of assignments and stuff that really deal with the distinction between these two, I was kind of coming away from it thinking that KVD will always be a smaller value because of the examples we went through in which they happen to be. But that's not true, right? Like you can actually have a KVD model in which your valuation ends up being higher because the growth rate in the KVD model is just depending on a different calculation for growth using NOPLAT. Is that
yeah,
right?
You're exactly right. It's actually what helps you determine if it's going to be larger or smaller than the free cash flow model is a band in which G and ROIC and WACC exists. And if G is outside of that band, it's going to be bigger. And if G is inside of that band, it's going to be smaller. Because you have G both in the numerator and the denominator. So it creates a range, right? Mm-hmm. But yes, you're right. KVD outcome is not necessarily larger or smaller. It's just most often a little bit different because of how we have estimated that G.
Okay. And then, sorry to ask this question one more time.
You're good.
I mean, now for KVD, it seems to me like KVD might be more reliable because of the way that you get G. I feel like it's a more sophisticated approach to getting G because of the involvement of multiple variables that you derive from the statements. Like, is that a fair assessment? Or, I'm sure it's hotly debated, but that's kind of what I think of when I see this this calculation. I start to think that it's a bit more involved and thereby might be more accurate.
Yeah, so you are singing the McKinsey & Company song, okay? So if you were to read any of the valuation books published by Kohler and his associates at McKinsey & Company, which happens to be, let's face it, the McKinsey & Company is the most successful consulting practice in the world. To the extent that we don't pay attention to them, it's either hubris, ego, or ignorance, right? So I think we need to pay attention to them. Whether you agree with them or not, or whether what they're talking about is applicable to what you're looking at is another issue. I formed the very first class I taught in any of this on McKinsey & Company's work and have flavored it with Demoteran's work, and I've learned a little bit of my own as well. So I dig the KVD model for the exact same reasons that you like it, Casey. It brings in a richness which I think it adds some accuracy as a result of this ROIC variable that we're missing expressly in the other models. That said, we are in the minority. If you ask 95% of the professional valuation consultants out there, especially those that come from the accounting industry, and about 60% of them, maybe 70% do come from the accounting industry. If you ask about the KVD model, they're going to look at you like, what planet did you just get off of? I don't know what you're talking about.
Yeah, you mentioned that last time.
Yeah. It's harder, right? But it doesn't mean that it's not better. So, yeah, I agree with you.
Thanks.
Thank you. So we have a tiny difference here in these two model outcomes, but we've seen before that difference isn't always tiny, right? We've seen big differences in these outcomes, and it may be higher or lower depending upon what our inputs are. That it is different tells us something. And I don't want to get too deeply into that because there's a lot of intuition that that won't make a lot of sense to you unless you let these things roll around in the back of your head and you've used them many times. But the intuition has to do with, is the growth sustainable given the return on invested capital and cost of capital relationship? You might remember that in one of our earliest discussions, I told you that growth creates value when return on capital is greater than cost of capital. Growth creates value when returns are greater than cost, which means we have profit, positive profit, right? Economic profit in this case, nonetheless, but we have positive profit, and growth makes that even bigger. Growth destroys value when cost of capital is less than return on capital. And as it turns out, the KVD equational form is the only one of the equational forms that really captures that well. And that's why McKinsey likes it. It's why DeMotorin likes it. It's why I like it. But we all recognize it's seldom used in professional valuation consultancy. But if you're doing some work within your own company, whether it's one that you own or one that you work for or one you've been retained to do some work with, it's a worthwhile model. So when I tell you that I always use the free cash flow model, I also should tell you that I always calculate the KVD model outcome. Sometimes I will publish that in the valuation report that I'm preparing, but only if it's meaningfully different and if I can articulate to the reader of that report what the relevance of that difference is, which is probably less than 10% of the times that I help put one of these together. Okay? So as we move on, we talked a little bit about the adjusted present value model. It's an alternative form. And to me, the virtue of this alternative form for you is just helping you realize you might have multiple cash flows that you're having to put together. And I think that that model form is just a good way of us talking about that. I don't want to go into details here of KU, K-tax, KD, KE, unless you want me to. I'm not going to be asking you a lot of questions with respect to them as we round out the term together. I don't expect you to do a lot with them. I expect you to be able to answer a question that would help me know that you realize if there's multiple distinguishable cash flows, then we have something that can embody them, especially if they have different discount rates associated with them. And I gave you the auto dealer example as one plausible. Another one might be, let's say that I'm looking at a company and it's got a construction division and it's got a healthcare division. Now that might be an unusual merging or marriage of operating assets for a company, but it's certainly not implausible. Well, I wouldn't use the same discount rate for a construction company that I would use for a healthcare company. The dynamics of the industries they're in are just completely different. So I might have to separate them out, identify separable cash flows and identify separable discount rates and value each one separately, but then add them together, which is really exactly what the APV equation does.